It seems the euro has gained a bit of composure off that bailout news for Ireland. Let's check in with Chris Gore, who joins us from GoMarkets in Melbourne, and Jim Brondas from OzForex in Sydney. Was anyone surprised, let's start with you, Jim, about the euro regaining a bit of composure, or just a short-term bounce?
I don't think it's too much of a surprise. The market was waiting on such an announcement, and so it's only natural we see some sort of a bounce out of that. We do think that over the course of this week or the next 24 to 48 hours in particular, that this move is likely to run out of a little bit of steam. It's a bit of I guess, a knee-jerk reaction or relief rally, as they call it in the markets.
So this talk, Jim, Chris Gore to you rather, good morning. This talk maybe of an overvaluation of as much as 10%. Is this going to be a slow simmer downwards for the euro and inevitably, or will it just be, what would be the catalysts? Because we've still got the Spains, the Portugals, the Belgiums, and even maybe Italy and France to worry about.
Yes, well, it's obviously quite hard to say. At the moment we're looking at the euro just above that 132 figure mark there, and so essentially, it certainly depends on whether or not these woes continue to sort of have a dire effect on the market. We may have seen the euro regain a little bit of composure in early morning trade, but it's unconvincing at this point. The true test comes when bond markets kick off for business, and we want to see this debt cost considerably less, and that will decide where the balance of risk falls, and essentially, if anyone was to be picking, there's certainly no doubt the euro's in a vulnerable state at the moment, but there needs to be a catalyst of events, including the bond market to continue to destabilise, to essentially have that effect on the euro, and then we're looking at support around the 130, the figure mark.
In terms of the short term, and I'm talking the week ahead, Chris, could the US data releases even just be enough of a distraction to take the focus off the euro?
Yes, certainly. Well, at the moment we've seen Black Friday sales kick off at a cracking start, and essentially this may be a welcome distraction, and of course we have employment figures coming out this week from the States, ADP employment change, and of course non-farm payrolls on Friday. So it'll be interesting to see which story takes priority. There's little doubt that if we do see some positive things coming out of the US, these could temper these fears coming from Europe, and if we're listening to the European officials come out this morning and suggest that that this will essentially alleviate some of the concerns in the Eurozone, we may very well see these concerns, I suppose, moderate to the very least, at the very least in the week ahead. But it is still very hard to say. Essentially, the market seems to not necessarily listen to any news coming out of these major, or any comment coming out of these officials, and when it wants blood, it goes after it, and certainly we've seen that in the past with Greece, and of course this one Ireland, and next in line seems to be Portugal, and a spillover from that would of course be Spain, but essentially very hard to say at this point.
Jim Brondas, can I put it to you that the bond market's not going to buy that for 1 minute from the EU finance ministers, that they need a mechanism now to say who will bear the losses as they come down the road? Will it be bondholders? If not, who will it be? Because until that's sorted out, the costs are spiralling for Spain, for Portugal, and for everyone else.
Yeah, certainly comments from German Chancellor Merkel along those lines, talking about those same things, who will bear the cost. I think this will drag on for a little bit in terms of deciding that, who will bear the cost of that. The important thing here also is the fact that the Irish have been given 10 years to pay this back. So certainly a lot looser conditions than what Greece were afforded with the 3-year plan. And we expect, although the market will continue to talk about Portugal and Spain, the issue of who will pay these back will linger in the background for some time. So we don't think it will necessarily be at the forefront of investors' decisions just at this point in time, unless we continue to get more talk from Germany and others about that, and then that issue does get more headlines. But the big issue here is, well, when will they pay it back? How much more will be required for the other European nations? And I think our view is similar along the lines of Axel Weber's in the big picture, that there's enough funds, or just about enough funds, in the rescue packages that have been put aside to fund Greece, Portugal, Ireland and Spain for the next 3 years, really, if that was required, which seems unlikely.
And then what do you think about how the US data will interplay with all of those factors in Europe through the course of the week and then affect that US dollar euro cross?
Well, the fundamental data has been in the background for the last couple of weeks since these issues emerged. So we expect that to continue until we get some sort of stability in that euro region, and also in Korea. One of the big reasons why the euro's weakened is a US dollar flight to safety and in risk aversion, and we think that that's likely to continue so long as this European sovereign issue and the Korean situation continues this week.
Chris Gore, is this actually a buying opportunity? The more that it's almost like this guilt by association that good as well as bad companies even are being sold down. What are you looking at as an opportunity in a climate of selling? Where should you be buying?
Well, I agree in many respects that the money is to be made when you're a step ahead of the market, of course. And at the moment, if we have a look at some of these high-yielding currencies such as the Aussie and of course the low-yielding yen, of course, also appears to be on a bit of a bounce to the downward region against the greenback, and of course stronger against major counterparts. And essentially, if you were to take a view that these European economic concerns were to have a brief reprieve at the very least, there'll certainly be some money to be made in some of these high-yielding currencies, such as the Aussie dollar. Of course, the euro is due for a bit of a technical bounce, so technically there is some cash to be made there somewhere.
Jim, just get it right, Jim. Do you also think that that whole yen slide is really just down to geopolitics at the moment? Fundamentally, that's what's moving it, and not much else.
Yeah, I think so. I mean, that flight back into the US dollar as well has got a lot to do with it. So we don't think that the yen weakness will remain longer term. We think that yen will start to strengthen again once we see a move back out of the US dollar. It's not going to happen this week, we don't think, but in coming weeks and into the new year, we do think that trend will re-emerge and we'll see that dollar-yen trade back lower again.
And Jim, what about the Australian dollar? Hit very hard last week, off 2.4%. I think it touched 96.13 over the weekend, and 95.4 is the October low. I'm seeing analysts say that's really lining up as the major support level. Where do you see the Aussie dollar tracking?
Yeah, 96.5 was the initial level on the way down. We broke through that on Friday. Whether that move can be trusted, we're still a little bit sceptical, especially given it was thin trading conditions offshore with the US practically on holiday. So we do think, though, however, that these rallies this week will be met with some strong selling, and probably that 95 cent level remains the key. And we're of the view that it's probably likely to hold at that level and bounce back towards that parity level at some point in the new year.
Just also that jobs print Friday, do you think Jim market is going to be just inevitably treading water because that one will trump all others and that doesn't come right till the end?
Yeah, I think so. I mean, it's probably in the first half of the week we'll continue to trade on the back of the comments out of Europe and Korea, but come Thursday, Friday, definitely the market's focus will switch onto that jobs number out of the US. It is quite critical, especially in the light of the QE to talk and actions from the Fed. So we're expecting an increase of about 140,000 jobs. That's down slightly from 150,000 last month, but it would give a point to a positive trend.
And Chris, just to finish very quickly with you on the Aussie dollar, your expectations?
Well, at this point, it's highly contingent on what happens in Europe, and if indeed this Irish bailout does moderate this selling across European markets, essentially there's some upside to be had. I think the focus will be on, including early in the week in US markets, Black Friday sales. This is a positive thing for the US economy and should translate as such to US equity markets, which is a key barometer for the Australian dollar. And of course, if we do see fears escalate across North Korea and the European region, we're eyeing the low 95s as potential support. 95.4 seems to be a little bit of support around that level. So essentially, over the course of the week, we think that that will be essentially the low of the week.
Chris Gore, thank you very much from GoMarkets, and Jim Brondas from Oz Forex. Thanks for joining Castle Night this morning.